Okay. So change in liabilities is 46,000 because it increased, and owner's equity
Decreased by 18,000.
18,000. So change in owner's equity is 18, so that's a negative 18. So therefore 46 minus 18 is 26,000. So since it's a positive number, that means assets increased by 26,000.
That's the accounting. Wait,
That's the accounting.
this is the core. This is the core. This is like.
This is what,
28,000.
This is what defines accounting.
This is like.
28,000.
Wait,
Oh, 28. Thank you. Good.
keeping it honest. Number 4 was D.
What's an
The,
example of
the answers are on the back, are on the last page. I memorized it.
what's an example?
Memorized all the 20?
I was not smart.
What's an example of other equity decreasing?
Owner's equity decreasing. Good point. Okay, owner's equity decreasing, dividends.
Okay.
You have a period where you made zero profits, but you paid a dividend. That's owner's equity decreasing. Or the other example is of course loss. No dividends, but you had a loss that period. So owner's equity will go down by the amount of loss. Anybody? Any other questions? The financial statement that summarizes the changes in retained earnings for a specific period of time is the, well, that's a given, retained earnings statement. What do you do?
Is that a quiz? I was on a quiz.
It could very, as I said, one of these questions may actually show up. Oh, by the way, your quizzes are not, they are not going to be the same. Obviously, your drawing, and depending on when you log in, you will draw a different quiz. So, Professor, which of the following statements is true? Publicly traded U.S. companies must provide an annual report to their stockholders when operating conditions change significantly. An unqualified independent auditor's report must be included in the annual report. Notes to the financial statements do not need to be included in the annual report because it's only for internal users. None of the answer choices are correct. The answer is D. Okay, number 1, publicly traded U.S. companies, they must provide no matter what. Exactly. So there is nothing like conditions changing significantly or anything like that. Every period, you have to provide this. Okay? 2, an unqualified. What is the difference between a qualified and an unqualified auditor?
Was certified?
No, both are certified. No, if the auditor is certified, that gives him or her the legal authority to actually audit the company and issue a report.
Like CPA.
Like a CPA, right? But what is the meaning of the word qualified in this particular case? Yes.
Isn't it related to conflict of interest? Like if someone has interest in a company, he's not qualified to audit that.
No, that's not what it is. That's not what it is. Conflict of interest is dealt with separately. That's an ethical issue. In fact, in some cases, due to conflict of interest, you are prohibited. You cannot even audit the firm because you have serious conflict of interest. So you can't do that. No, the unqualified report comes in the following. An auditor's report, okay, typically has, in fact, I'll go through the Eli Lilly statements now after we start with this. The auditor's report typically has 3 things. Okay, the auditors today under the U.S. law, after Sarbanes-Oxley Act got passed, the auditors today make 2 reports. Okay, one is the traditional report that they've been doing all these years. And that report is where they say, what did we do, how did we do it, and what did we find? 3 things. Okay, what did we do? We audited. We looked at the financial statements. Okay, and that they will also say what they did not do or what they are not responsible for. And that is, the preparation of the statements is not the auditor's responsibility. The management has to prepare the statements and give it to the auditors. So the auditors have to say, we have to go by the statements prepared by the management, and then we do our audit based on our assessment of what it is. Okay? That's number one. That is what they did. How they did it, they will tell you, okay, these are the standards that we have followed, and these are the parameters that have guided our report. Okay, and we did sample thing. We didn't look at every transaction. We picked the sample of transactions to look into based on our understanding of the business, of the company, the management, and things like that. Then the third is where the qualified comes, is where they say what they found. Typically, a clean report is where they say everything is okay. That's called a clean report. The qualified report is where they say everything is okay except for these things. Where they will list the things where they differ with the management. The management approached a particular accounting issue one way, and the auditor said that's not the way to approach it. That's called a qualified report. Or sometimes the auditor might say, this management has been changing a policy every year or too frequently. So everything is okay except for the fact that the inventory policy has been changed 3 times in the past 5 years. Something like that. That's called a qualification. So when you have an unqualified report, that's the best outcome that you can get from the auditor. Okay. So it's either you say it's qualified or unqualified. But of course, there is a category that is worse than qualified. That's when the auditor actually questions the future viability of the firm based on the financial numbers. The auditor will say, you know, the ability of this company to continue as a viable, you know, say going concern is in doubt. That's the worst report that you can get. At that point, you're already looking at bankruptcy. When the auditor say that. All right. So that's what is called a qualified report. So it's not like, okay, you know, only an unqualified report has to be given. Even if it's a qualified report, you have to put it in the annual statement because that's a legal requirement. Now the company can do a rebuttal. They can say that this is the reason why we don't agree with the auditor. So they can put the rebuttal also in the annual report, but you cannot change the auditor's in the report. So if it is qualified, yes, it is qualified. That's how you have to report it.
There's a form, it's like AC 265 or something like that, could it be? I'll find out and I'll tell you right now. That comes with the audited report. With the,
Oh, okay.
There's it's something about federal internal government or something like that.
That's a second report. That is the one on internal controls.
Mm-hmm.
That came after Sarbanes-Oxley. After the Enron scandal, Sarbanes-Oxley Act was passed by Congress, and that required the auditors not only to do the traditional audit report, but also a separate audit of internal controls.
So the qualifying aspect is more like a limitation when you're writing a paper.
Perfect. Perfect. It's a limitation of the clean report that the auditor issued.
And so that
Say that again?
it will always go on an annual report, whether it's qualified or not qualified.
Yes, it will always go there. Okay, number 8. Jackson Company recorded the following cash transactions. What was their net cash provided by operating activities? Now, this is something that I briefly discussed when we did the boot camp, that when we looked at the statement of cash flows, I said the statement of cash flows must separate out operating, investing, and financing. Right? I talked about that. And that's a very important distinction. So you got to look at business activity and classify them into operating, investing, and financing as much as possible. Sometimes an activity may have more than one element to it, but if it is primarily operating or primarily investing, that's where it should go. Okay, so here's an example. What you have to do is to look at all these items and say which one of these items or which one or more of these items would be considered as operating activity. So let's take the salaries. Is that operating?
Yes.
What about 60,000 to purchase equipment?
Yes. No?
That's investing. The difference between buying inventory and buying equipment is that when you buy equipment, that is investing because the benefits come for a long time. If it is inventory, the benefits are short term, so that is operating. If you pay salaries, you've already received the benefits, so when you pay the salaries, it's obviously operating. If you pay utilities, you pay property taxes, all those are operating. Typically, you know, the rule of thumb is that anything that is very short run in nature will constitute operating. Okay, so the office equipment will not count. What about paid 15,000 for utilities?
Yes.
And 6,000 in dividends?
No.
No, dividends, paying dividends to your stockholders is considered a financing activity.
Yeah.
It is like giving their money back to them. It is like, it's not exactly returning the money, but it is like distributing a part of their investment back to them. So therefore, when you pay dividends to your stockholders, that is considered financing. Okay. Collected 245,000 from customers. What is that? That would be operating. So you make a sale, you collect the money from your customer. That is part of operating. So the answer is 95,000. You all agree?
345 minus 135 minus 15.
95.
245 minus 135 minus 15. That's it, right?
Mhm.
Yeah.
It was A, the answer. Because the operating activities are paying salaries, paying for utilities, and collecting 245 from customers. And when you sum up those numbers, you come up with 95,000.
How is that 95,000?
Because it's.
Because collected 245 is cash is coming in, 245. That's a positive 245. When you pay 135, that's a negative 135 because it's going out. And 15,000 when you pay, that is also negative. It's going out.
Okay.
So you take 245 minus 135 minus 15. A business is usually involved in two types of activity, financing and investing. The answer is no, because we know that there are three activities. We know there are three activities, operating, investing, and financing, so therefore the answer is false. A different set of financial statements usually is prepared for each user.
No.
The answer is no, certainly not. Multiple users, their needs are all considered in the four financial statements, so therefore there's only one set that comes out here.
What's the definition of user in this scenario?
Okay, user would be, it's a good question. User would be what we call as a stakeholder. A stakeholder is a group that is interested in the financial health of a firm. So government would be a stakeholder, investors are stakeholders, banks or lenders are stakeholders. So these would be examples of stakeholders. Okay, regulators, SEC would always be a stakeholder in the. Yeah, it's basically, yeah, exactly.
Because it would be the same numbers anyway, right?
It has to be, obviously, because if you're producing only one balance sheet, that balance sheet is looked at by SEC, it is looked at by investors, it is looked at by banks, everybody looks at the same balance sheet. Right? So it is not that you prepare a balance sheet for SEC and a separate balance sheet for the bank. You can't do that.
Has it ever been done with, because that's who it would be.
You just can't do it. There's no way to cheat. I mean, you'll get found out